Hey guys, and welcome to the second video of chapter 3 where we were discussing CVP analysis and all the formulas and how you apply them to certain questions. So here in front of me I have a question that I've made up and one where we're going to solve for 5 parts. And the way that I'm going to go about this is I'm going to divide the videos into 2 parts. So in this video we're going to address as many as we can. Alright, so let's get started with the first part. Gary CD sells fire albums. The company sells 3 types of albums, jazz, rock, and EDM. The information is given. So the company has annual fixed costs of $50,000 and a tax rate of 30%. And then individually for each product that this company has, they have given information such as sales price, variable costs, and the expected sales. All right. So the first part is simply asking you to compute the company's expected profit. In other words, it's asking you to draw up an income statement. So over here, I have a format for the income statement. You have the name, the income statement, and for the year ended, we're just going to assume it's December 31st, 2015. This is the remember guys that format is key in any accounting course. So this is the general format that you would draw up for any income statement. All right, so now we're going to get started with the sales bit. So over here we have sales price of 100 and expected sales of 500. So it's going to be 100 times 500, so that's 50,000. I just like to do it on the calculator because my mental math is terrible. All right, so it's 500 times 100. Just for your reference, I'm going to write out the calculation at the bottom. All right, guys, so moving on to the next one, it's 300 times 250. So 300 times 250 is 75,000. One second. Yeah. And for the last one, it's 400 times 200. And that is 80,000. So 400 times 200. That is your sales for each individual product, mind you. All right. So now you want to find the total variable costs. Am I right? So I'm just going to draw a line here so that there's no confusion. So onto the variable cost. So it's 50 times 500. So is 25,000. And then 120 times 250, that's 30,000. And finally, for the last one, it's 250 times 200. That's 50,000. All right, so that's your variable cost. And sales minus variable cost is contribution margin. So basically what you're finding here is your total contribution margin for each product individually. So 50 minus 25, that's 25. And then 75 minus 30 is 45. And then 80 minus 50, is that 50? Yeah, is 30. So that is your contribution margin for each product individually. And now that you have your contribution margin, you have a total fixed cost of 50,000 for the entire firm. So what I do here is I take a total contribution margin figure by adding up all 3 of these together. So adding these up, I get 25 plus 45 plus 30, which is a perfect 100,000. All right, guys. And then I'm going to take out the fixed costs of 50,000 to arrive at a total profit for the business, meaning a total profit of 50,000. There you go. That's your profit, and that is your final answer. That is also your net income, if you will. All right, guys, so that was pretty straightforward. We can move on to the next part. So the next part is asking compute the company sales mix. So the way that I'm going to show you guys how to actually compute the sales mix, the way that I do it is much simpler than the way that a textbook does it. If you find the textbook method easier, then go for it, but this is the one that I'd advise you to remember for your midterm or your finals. All right, so for my method, all you have to do is to add up the expected sales for all the products. So that's going to be our first step. So we're going to take 500 plus 250 plus 200, and that gives us 950. So basically, you have a total sales figure of 950 units. Now, essentially what your sales mix means is that your sales mix represents how much of an individual product represents the total sales. So how much of this 950 is made up of jazz, how much of it is made up of EDM, and how much of it is made up of rock. So that is basically what we're trying to find here, and this is how you do it. So the categories are jazz, rock, EDM, jazz, rock, and EDM. And then what you're going to do is you're going to take individual expected sales and then divide them by the total. So it's going to be 500 divided by 950. And it's going to be 250 and 200 with the same thing. So 250 and 200 divided by 950. And what you're going to get here are percentages. Now those percentages represent, again, what I just mentioned. So 52.6316. 316. Remember, guys, to take 4 decimal places. That is the best and safest bet that you can have for decimal places, because often, even though your profs may not be that strict about it, but you want to get the right answer the first time. So that's the one for the first one, and then 250 divided by 950. It's 26.3158. So 26.3158%. And finally, it's 200 divided by 950. So that's 21.0526. 21.0526%. Those are your total percentages for each product, right? And those are essentially your sales mix. That's it. That's all you need to remember for sales mix. It's very straightforward to follow this method. But again, if you understand the textbook method better, then go for that. Okay, so first two are down. So moving on to the third one, which is assuming a consistent sales mix, how many units of each product type must the company sell to break even? All right, this is where the question gets tricky. Now, what you need to remember in this part of the question is that you're taking the sales mix for the entire business, not just individual products. So for that reason, first off, we're gonna recall what the break-even formula is. So break-even, again, in units, is when you take your fixed costs and divide it by your contribution margin per unit. But the question is, how would you find the contribution margin per unit for the entire business when you only have per unit information available to you for each product? How would you find it for the entire business? Well, this is where your sales mix comes into play. This is where these things come into play. All right, so we're going to do this part now. So this is part C. So when it comes to the fixed cost, that's pretty straightforward. That's 50,000, which is given to you right here. Right here, it's given to you 50,000. So that's pretty straightforward. But now you really want to find your contribution margin according to these percentages, because it has to be for the entire business again. So we're going to leave this here for now, and we're going to find the contribution margin for the individual product. So it's going to jazz, rock, and EDM. So the contribution margin for the first one, 100 minus 50 is 50. For the second one, it's 300 minus 120, which is 180. And for the last one, it's 400 minus 250 is 150. Okay, So now again, all this entire 50 or this entire 180 is not going into the final contribution margin per unit for the entire business. The portion of this that goes into the bottom, into the denominator, is this percentage that we found out here. So it's going to be 50 multiplied by 52.6316%. So 52.6316% plus 180 times 26.3158%. So 180 times 26.3158% plus 150 times 21.0526 21.0526%, and there you have it. Now I'm going to do this long calculation and then we're going to see what we get. So it's 50,000 stays on top, so it's 50 times 0.526316 plus, I'd encourage you guys to also do the calculation so that if I'm wrong you can alert me in the comments so that I can really correct this video if needed. 0.210526 3158. Yeah, that looks good. So what it comes out to on my end is 50,000 divided by 105.26, and ultimately that comes out to 475.0143. All right, and you can round this off because these are just the number of units that you needed to break even. So basically 475 units. So if the business sold 475 units while staying consistent with this sales mix, so Jazz made up 52.6316% of the total sales and so on. If the sales mix stayed consistent like this and the company sold 475 units, then the company would incur neither a profit nor a loss. Basically, they would be selling just enough to cover all of their costs at this point. All right, guys, so that's it for this video, and the rest of the two parts that I have to cover I shall do in the next video. Stay tuned, guys.